Welcome to Spreadsheet Geek. In 1964, a young Warren Buffett in his mid-30s took over an ailing textile company called Berkshire Hathaway. In the decades that followed, Buffett built Berkshire Hathaway into one of the largest business conglomerates in the world. In doing so, he made himself and many other people very wealthy and became the world's leading authority on investing. In the most recent decade, however, Berkshire Hathaway has lagged behind the market. In this video, we'll take a look at the magnitude of that underperformance and the possible reasons why it happened. This video was made using Microsoft Excel 2019. If you go to BerkshireHathaway.com's homepage, you can click on Annual and Interim Reports and scroll down to 2019 and get the most recent annual report in PDF form. I'm interested in one particular part of this report that appears on page 4. It's Berkshire's performance versus the S&P 500. It's a one-page report, a comparison of Berkshire Hathaway's performance. For example, in 1965, it was up 49.5%, while the S&P 500 was only up 10%. Berkshire obviously outperformed the market quite a bit in that particular year. There's a way to pull this report straight into an Excel worksheet. Let's do that. The first thing you need to do is copy the web address of this PDF document. Then I'm going to jump over to a workbook I just opened up, go to Data, and we're going to get data from the web. Once that opens up, you can go ahead and paste in your web address that you copied, say OK, and connect. So you get a little presentation like this in a new Power Query window, and you have to click on the document here to open it up, and it's going to present to you all of the different tables and content that are in this document. Now remember, that table we were interested in is on page 4 of the document, so I'm going to click there. This is a preview of my download. Looks good. So I'm going to go up here in the upper left-hand corner and hit Close and Load. And after a few minutes, here's my table already formatted for me with all the numbers I need. I'd like to chart this outperformance of Berkshire Hathaway. I'm going to get rid of this column because there's nothing in it. And I'm going to add another column over here and call it BRK for Berkshire Hathaway Outperformance. That column is just going to be quite simply Berkshire's performance in percentage minus the S&P 500. Let's fill that down. Now I'd like to make a chart of this through 2019. We'll insert a bar chart. I'm going to rename the chart appropriately. And I'd like to relabel this horizontal axis. So we'll edit the horizontal axis with our years. Sometimes I think it helps if you go to your horizontal axis and format it. Go over here to Text Options right here, and you can put in a custom angle. And let's go with that. I think these are a little easier to read at an angle. So I think this chart is very telling. Look at the outperformance of Berkshire Hathaway versus the S&P 500. It looks like 1976 was really a banner year. In 1976, Berkshire Hathaway was up 129%, while the S&P 500 was only up 23.6%. That's a stunning outperformance. And there's some other very good years in here. This is when Warren Buffett really made a name for himself. Not without mention, though, there are some years where Berkshire Hathaway, in fact, 2 in a row here, where it's significantly underperformed the S&P 500. In more recent years, it looks like Berkshire is really kind of struggling versus the S&P 500. We have not seen a consistent outperformance, and in quite a few of these years, there's 3 recent years, it's basically mimicking the S&P 500. Let's go ahead and throw in a trend line. We'll do a linear regression trend line. The line is obviously trending down. If we look at a chart of Berkshire Hathaway A shares versus the S&P 500 year to date, we see roughly a 9% disadvantage for Berkshire Hathaway, which just didn't recover quite the same way as the COVID-19 crisis unfurled. And this blue line for the S&P 500 index does not take into account S&P 500 dividends, which are, I believe, around 2%, maybe a little less. So that would add on another approximate 2%. If I were to guess, I would say Berkshire will underperform the S&P 500 this year by about 10%, and that's just a guess. We'll see how it turns out. I'm going to put in a negative 10 here, and then look at the last 10 years comparatively. We see that Berkshire is underperforming by close to 2% on average over the last 10 years. So why has Buffett and Berkshire Hathaway outperformed for so many years? Well, after reading The Intelligent Investor by Benjamin Graham and several books about Warren Buffett, I would chalk it up to 4 things. Number 1, Buffett buys companies below their intrinsic value. He computes this intrinsic value fully independent of what any pundit says about what a company's worth. One book I read stated that Buffett's interest really isn't peaked until the price falls to at least 80% of intrinsic value. This is what's known as value investing. Another thing Buffett does is he owns complementary businesses. These are situations where older, mature companies cranking out steady profits can finance companies that are still in the growth stage. Buffett employs extreme discipline in his investing. Once he decides to take an equity stake in a company, he sticks with it unless something dramatically changes his expectations about the outcome. Finally, many who write about Buffett have stated that although he preaches against the use of leverage, he has used it quite effectively to increase his shareholder value. I believe there are 2 main factors that have resulted in the underperformance of Berkshire Hathaway in the last 10 years. I'm going to focus in the remainder of the video on those 2 areas. Warren Buffett is the quintessential value investor. I believe that value investing has fundamentally changed from the decades of the 60s, 70s, 80s, and 90s. This is actually one of the biggest debates in the investing world right now. It's a debate about whether the value premium has vanished. So what is value investing? Value investors seek equities trading at low multiples of some metric, usually earnings or book value. Companies trading at those low multiples are usually higher risk businesses with uncertain futures. Often they're mature businesses that have been ongoing for a very long time. Often there are questions about whether these companies can adapt to a changing future. These companies tend to be more leveraged with a lot of debt on their balance sheets. The reason Buffett and other high-profile value investors and value investing in general have done well over the years is because of what's called the value premium. What is the value premium? Well, let's say you were going to invest in the S&P 500 today at time 0, and then liquidate your investment a year from now. You would reasonably expect that the outcome would fall within a range. Positive or negative, it will probably be within that range. You'd probably have an expectation that the dispersion of outcomes of your S&P 500 investment might look like this, with many possibilities clustered around the center and a few extremes. The long-term return of the S&P 500 from the 1920s to present is in the 6 to 7% range, so let's just say your median expectation is 6%. That would lie in the middle of that cluster. At the extremes would be your best and worst expected returns, and I'm not even going to put a number on those. But that's the situation with an investment in the S&P 500 or the total market. Now consider the alternative of investing in a subset of the total market that includes only value stocks. Academic research has shown that the value dispersion of value stocks only is tilted upward, at least 3 or 4% in some periods. This in large part explains the success of Buffett and of other high-profile value investors like Bill Miller. And this extra few percent is what's known as the value risk premium. The value premium is logical. You get a few extra percentage points of return on average for taking on additional risk. The problem is that more recent academic research has shown that the value premium has either gone away completely or been greatly diminished. Why would the value premium disappear? Well, it's been said that when something works well on Wall Street, everybody does it, and it doesn't work well anymore. In that case, the value premium may be gone forever, but I don't believe that's the case. I think the value premium will make a comeback, and the last 10 years have not given us that because investors have been preoccupied with big tech names. Big tech names have soared while the rest of the market has been quite unexceptional. If you want a little more perspective on how big tech carried the S&P 500 in 2019, check out my video on the skew of S&P 500 returns. I'm going to do something I don't often do on my channel, and that is plug another YouTuber's channel. There's a guy named Ben Felix who does outstanding videos. His channel's called Common Sense Investing, and if you want to know more about the value premium and other premiums like the size premium, his videos are excellent. He dutifully cites every academic source, and he works in the financial industry. So getting back to those two reasons for Berkshire Hathaway's outperformance decline over the years, we talked about the value premium and the decline in value investing over the last 10 years. The second reason I think is more significant, and that's the sheer size of Berkshire Hathaway assets under management. There is a limited universe of investment options for Berkshire Hathaway in this present day that simply did not exist back in the 60s through 80s. Berkshire Hathaway is ballpark $1.5 trillion under management, and if you look at their holdings in the 2019 annual report, it's a list of very large companies, including the largest company in the world, Apple Computer, which has roughly a 23% weight among Berkshire Hathaway holdings. So I'd like to go back to this one vertical axis chart and convert it into a two-axis vertical chart where I give some indication on here of how much Berkshire Hathaway has grown over these years in just the sheer size of assets under management. And that's going to be fairly simple to do because no shares, to my knowledge, have ever been issued since the beginning. In other words, there's never been a new share offering. There were some shares retired in 2019 and an additional $5 billion in 2020, which is not even going to be on our chart. But those are actually, in spite of being large sums of money, they're not very significant in terms of the market cap. If you retire $2 billion out of over $600 billion in value. So $12.50 was the approximate value of a share at the end of 1964. That's a Class A share. The Class B shares were not created until I think it was 1996, where Class A shareholders were given the opportunity to split their shares into Class B shares. So that didn't create any either. We'll take the $12.50 and multiply it by 1 plus this growth rate of Berkshire Hathaway divided by 100. And we'll get to 1869 in the second year. I'm going to paste that formula down one more time because I have to correct just one thing right here, and we'll take this reference down instead. So we had a small decline that year. That makes sense. Let's autofill that down to the bottom. This is very close to the year-end value on 2019. Excuse me, this one right here. That's very close to the year-end value of a Class A share in 2019. So let's go ahead and put these on the chart. So to add another element to this chart and make it a two-axis chart, you just select data. I'm going to add another series of data. The series name will be BRK size. This growth in one share will reflect accurately, pretty close, the growth of the assets under management. The values will be right here. We'll say OK to that and OK. And it just by default put it into another bar chart. So I have one little blue bar chart that you can barely see here and an orange bar chart. What we need to do is change our chart type. This will be a combo chart. I want my series 1 in clustered columns, and I want my series 2 in line on a secondary axis. So it'll look like this. There's a good preview. So that really does show the dramatic growth since the early 90s. Berkshire Hathaway just really took off. And let's put a trend line on that one as well. It'll be a linear regression trend line. So we have trend lines that are going almost exactly at the opposite slope of one another. And this is what I feel is the major factor with Berkshire Hathaway. It's just so big that the investment options are so limited. And Buffett himself has talked about this on many occasions. Somebody invariably will stand up at the annual meeting and ask him where he thinks the great opportunities are, and he'll say something to the effect that, well, I'm sure there's a lot of opportunities in small caps right now, but I don't even bother to look there because Berkshire Hathaway cannot participate in those opportunities. We could, but it wouldn't even put a dent in our bottom line, even if the company doubled or tripled in a year. To sum it up, why has Berkshire Hathaway slightly lagged behind the S&P 500 for the last 10 years? Number one, the value investing premium has melted away, probably temporarily. Number two, the sheer size of Berkshire Hathaway makes it nearly impossible to repeat the performance of the 60s, 70s, and 80s. That problem, I believe, is not going away. It reminds me of Peter Lynch's Fidelity Magellan Mutual Fund, which grew so big that he had the same problem that Berkshire is having now. We may have seen another similar situation with Bill Miller's Legg Mason Value Fund, a very successful run of beating the S&P for 15 years running, but then he had a dry spell where he underperformed the S&P 500 for about 5 years straight and then eventually went on to do something else for a living. I hope you've enjoyed this video. Make sure you check out my other video on skew of the S&P 500 returns. That video in many ways explains some of the difficulty Berkshire Hathaway is facing, or any large fund that invests in large cap companies. Make sure you also check out Ben Felix's channel. It's called Common Sense Investing, and he really does excellent videos, as I said previously. If you think this video was worthwhile, please hit my subscribe button and look for another video next week. Thank you for visiting Spreadsheet Geek.